You know what's wild? There's this invisible line at $50,000 that literally changes everything about how money works in your life. And honestly, most people have no idea it even exists until they cross it. Look, I've analyzed thousands of financial journeys over the past 8 years, and I keep seeing the same pattern emerge over and over again. People struggling at $30,000, grinding at $40,000, and then something fundamental shifts at $50,000. It's like the entire game changes its rules overnight. But here's what nobody tells you. It's not about the money itself. That $50,000 threshold, it's actually a psychological, biological, and mathematical trigger point that rewires how you make decisions, how you sleep at night, and honestly, how you see your entire future. I'm going to walk you through exactly why this happens, what's going on in your brain when you hit this number, and most importantly, how understanding this shift can help you whether you're at $20,000 trying to get there or at $75,000 wondering why things feel different. Because the part that shocked me most when I started researching this, the $50,000 threshold isn't arbitrary. There's actual neuroscience, behavioral economics, and real-world data backing up why this specific number acts as a pivot point in your financial life. So if you've ever felt like you're grinding but not making real progress, or if you recently crossed this threshold and noticed things feeling different, this video is going to explain everything. And honestly, by the end, you're going to see your own financial journey in a completely new light. Stay with me because around the 8-minute mark, I'm going to reveal the single biggest mistake people make right after crossing $50,000. And it's probably not what you think. But first, we need to understand what's actually happening in your brain and your bank account when you hit this number. Let's dive in. Okay, so here's where things get fascinating. Your brain has been shaped by millions of years of evolution to prioritize one thing above everything else: survival. And in our modern world, money equals survival. Research from Princeton University's Woodrow Wilson School found something remarkable. They studied over 450,000 responses from Americans, and they discovered that emotional well-being rises with income, but only up to about $75,000. But here's the key part nobody talks about. The most dramatic shift happens between $40,000 and $60,000, with $50,000 sitting right in that sweet spot. Think about it. Below $50,000, especially in most US markets, you're in what I call survival mode math. You're calculating, can I pay rent? Can I cover an unexpected $500 car repair? What happens if I get sick? Your prefrontal cortex, the part of your brain responsible for long-term planning and rational decision-making, is literally being suppressed by your amygdala, your stress center. This isn't weakness, this is biology. A Harvard study on poverty and cognitive function found that financial stress reduces cognitive capacity by about 13 IQ points. That's the equivalent of losing a full night's sleep or being legally intoxicated. You're not making bad decisions because you're bad with money. You're making survival decisions because your brain is in protection mode. But when you cross $50,000, something profound happens. Suddenly, you have what researchers call cognitive breathing room. Your baseline expenses are covered with buffer space. That $500 emergency, it's stressful, but it's not catastrophic. And your brain knows this. Your cortisol levels drop. Your sleep quality improves. Studies show that financial security improves sleep by an average of 47 minutes per night. That's nearly 6 hours more sleep per week just from having financial breathing room. And here's what's really interesting. This isn't about luxury, it's about predictability. Your brain craves predictability. Below $50,000, every month feels like a high-wire act. At $50,000 and above, you can actually predict your next 3 months with reasonable accuracy. Now, I know what some of you are thinking, but I live in New York City, or I've got student loans, or I have kids. Look, the exact threshold varies by location and circumstance. In San Francisco, it might be $75,000. In Austin, Texas, it might be $45,000. The principle stays the same. There's a number where your brain shifts from survival mode to building mode. And for most Americans, averaged across the country, that number clusters around $50,000. Comment below with your location and what you think that threshold is where you live. I'm genuinely curious to see how this varies across different cities. But understanding the biology is just the first piece. Because once your brain makes this shift, something even more powerful happens with your behavior. This is where things get really interesting. And honestly, this is the part that changed how I think about wealth building entirely. Below $50,000, you're trapped in what I call linear survival. Every dollar you make goes directly to immediate needs: rent, food, utilities, debt minimum payments. You're not building anything, you're maintaining. But at $50,000, assuming reasonable cost of living, you hit something magical: disposable income that can be deployed strategically. Let's run the real math. Take a single person making $50,000 in a median cost of living area. After taxes, roughly $40,000 to $42,000. Basic necessities, rent, food, utilities, transport, about $30,000. That leaves $10,000 to $12,000 in true disc. Now here's what most people miss. That $10,000 discretionary isn't just extra money, it's compound fuel. And this is where the exponential curve begins. If you invest $800 per month, which is very doable with that discretionary income, at a conservative 8% annual return, in 10 years, you have $147,000. In 20 years, $471,000. In 30 years, over $1.2 million. But someone making $35,000, after necessities, they might have $2,000 to $3,000 per year in true discretionary income. The math just doesn't work the same way. They're not irresponsible. They're mathematically constrained. This is what I mean when I say everything shifts. Below $50,000, you're playing addition. Dollar in, dollar out. At $50,000 and above, you unlock multiplication. And it's not just about investment returns. It's about opportunity access. You can afford to take that weekend course that costs $400. You can invest in better work equipment. You can maintain a professional wardrobe. You can say yes to networking dinners. You can afford the car maintenance before it becomes a major repair. Each of these isn't just an expense. It's an investment that creates more opportunity, which creates more income, which creates more investment capacity. Think about it this way. Below $50,000, you're paying the poverty tax. You can't buy in bulk because you don't have the cash flow. You pay overdraft fees, you pay late fees, you get the higher insurance rates because you can't pay annually. You buy cheaper items that break faster. The Urban Institute calculated that low-income Americans pay about $40 billion per year in fees and extra costs just for being low income. That's insane. At $50,000, you escape most of these traps. You can buy the $200 boots that last 5 years instead of the $40 boots you replace every year. You can put 6 months of car insurance on a credit card for the discount and pay it off immediately. These aren't huge wins individually, but collectively, they add up to thousands of dollars per year that stay in your pocket instead of going to fees, interest, and replacement costs. And here's something I want you to really hear. If you're not at $50,000 yet, this isn't about judging where you are. This is about understanding the game you're playing so you can develop a strategy to change it. Because once you understand that the system is mathematically stacked differently at different income levels, you can make more intentional choices about how to navigate upward. Segment 3, the identity shift, who you become. Now we need to talk about something that's harder to measure, but maybe even more important than the math: your identity. Humans are story-making machines. We create narratives about who we are, and then we live into those narratives. And your income level dramatically affects the story you tell yourself. Below $50,000, especially if you've been there for years, your internal narrative often becomes, "I'm someone who struggles with money. I'm not good at this. I'll never get ahead. The system is rigged against me." And look, some of those statements have truth to them. The system does make it harder at lower income levels. But when that becomes your core identity, it affects every decision you make. But something fascinating happens when you cross $50,000. Your story starts to change. Suddenly, you're not someone who can't afford things. You're someone who chooses how to spend. That's a massive psychological shift. Dr. Brad Klontz, a financial psychologist, calls this your money script. It's the unconscious beliefs you hold about money, and they're incredibly powerful. When your money script shifts from scarcity to possibility, your entire relationship with money transforms. You start thinking in terms of how can I instead of I can't. You see opportunities instead of just obstacles. You start planning in years instead of just months. I've seen this play out hundreds of times. Someone crosses $50,000 and within 6 months, they're having completely different conversations. They're talking about retirement accounts. They're researching investment strategies. They're asking about side business ideas. It's not because they suddenly got smarter. It's because their brain has bandwidth to think beyond next week. And when you can think beyond next week, you can start building something meaningful. Here's a perfect example. Below $50,000, if someone mentions starting a side business, the immediate thought is often, I don't have time or money for that. At $50,000, that same person might think, interesting, I could allocate $100 a month and a few weekend hours to test that. Same opportunity, different identity, different response. And this is where I need to address something important. Some people cross $50,000 and don't make this identity shift. They keep living in scarcity mode even though the math has changed. Why? Usually because of childhood programming around money, or because they don't trust the stability of their income, or because they've been burned before and they're afraid to hope. If that's you, I get it. Financial trauma is real. But recognizing that you're safe enough now to start thinking differently is the first step to unlocking everything that $50,000 makes possible. Your identity shift isn't automatic, it's intentional. Segment 4, the social shift. Your circle changes. Okay, so this next part is something people don't talk about enough, but it's absolutely crucial. Your social environment changes at $50,000, and this change either accelerates your growth or holds you back. You know the saying, you're the average of the 5 people you spend the most time with. There's actually solid research behind this, particularly when it comes to financial behaviors. A study from the Federal Reserve Bank of Boston found that your likelihood of defaulting on a loan increases by 30% if someone in your social network defaults. Your savings rate correlates strongly with your friends' savings rates. Your investment behaviors mirror your peer group. We are deeply social creatures, and we unconsciously calibrate our financial behaviors to match our social environment. Below $50,000, your social circle is likely dealing with similar struggles. Conversations center around bills, finding deals, complaining about money stress. And this isn't bad, it's just reality. But at $50,000 and above, you start having access to different social circles. You can afford the professional association membership. You can attend the conferences. You can say yes to dinners with colleagues who are further along in their careers. You can invest in the gym or hobby spaces where you meet different types of people. And this exposure changes everything. You start hearing different conversations, investment strategies, real estate opportunities, side business ideas, career advancement tactics. It's not that people below $50,000 don't have valuable knowledge. It's that the knowledge networks you access at different income levels are fundamentally different. But here's the trap, and this is huge. When you cross $50,000, you face a choice. Do you lift your old social circle up? Do you leave them behind? Or do you try to straddle both worlds? This is the uncomfortable truth nobody mentions. Some friendships don't survive income differences. Not because anyone is bad, but because lived experiences diverge. Your friend still struggling at $35,000 doesn't want to hear about your investment portfolio. It feels tone-deaf. Meanwhile, you can't relate to the daily financial stress anymore, so conversations feel disconnected. The healthiest approach I've seen is intentional bridge building. You maintain relationships based on shared values and experiences beyond money, while also allowing yourself to grow into new social circles that support your current reality. Because here's what happens if you don't navigate this carefully. Either you stay limited by your old social circle's financial mindset, or you completely disconnect from your roots and lose important relationships. Neither is optimal. Segment 5, the mistake zone, what kills momentum, 750 words. All right, this is the part I promised earlier. The biggest mistake people make right after crossing $50,000. And honestly, This is what separates people who use this threshold as a launch pad versus those who plateau right here. The mistake is lifestyle inflation at the exact moment when you should be building leverage. Let me explain why this is so destructive. You finally hit $50,000. After years of struggling, you have breathing room, and your brain, which has been in deprivation mode, sees opportunity. You get the nicer apartment, you upgrade your car, you start eating out more, you buy the things you've been putting off. You justify it all with, "I deserve this," or "I work hard for my money." And look, you do deserve nice things, you do work hard, but here's the brutal truth. If you inflate your lifestyle to match your $50,000 income, you recreate the exact same financial pressure you just escaped. Suddenly, you're back to living paycheck to paycheck, just with nicer stuff. You lost the compound advantage. You lost the cognitive breathing room. You're back to survival mode, just at a higher price point. The math is simple but devastating. If you increase your spending from $30,000 to $40,000 when you hit $50,000, you go from having $10,000 per year in compound fuel to having $2,000. You just destroyed 80% of your wealth building capacity. And the worst part? You adapted to the higher lifestyle. Now it's your new baseline. Downgrading feels like punishment, even though logically you know the old lifestyle was fine. This is called the hedonic treadmill, and it's one of the most powerful forces in personal finance. Every lifestyle upgrade feels amazing for about 3 months, then becomes your new normal, and then you're looking for the next upgrade. So what's the alternative? The strategic move is what I call the 70-20-10 split, right after crossing $50,000. 70% of your income goes to living expenses, same as before. 20% goes to building leverage, investments, education, business. 10% goes to lifestyle upgrades. Yes, you get to enjoy some improvement. This way, you avoid the deprivation that leads to binge spending, but you also capture most of the compound advantage that makes $50,000 transformative. Think about it. That 20%, which is $10,000 per year, becomes your wealth engine. The 10%, which is $5,000 per year, gives you permission to enjoy the progress without guilt. Maybe that 10% is a vacation you've always wanted. Maybe it's upgrading one room in your apartment. Maybe it's a hobby you've been postponing. Whatever it is, you've budgeted for it consciously. The people who build real wealth from the $50,000 threshold are the ones who resist the urge to look wealthy and instead focus on building actual wealth. And this is hard because we live in a culture that judges success by visible consumption. Your coworkers upgrade their cars, your friends move to fancier apartments, social media shows everyone living their best life. But here's what I've learned from watching thousands of financial journeys. The people flexing at $50,000 are often still at $50,000 5 years later. The people who stayed intentional at $50,000, they're at $80,000 or $100,000 5 years later, with actual assets built. Which person do you want to be? Segment 6, the acceleration phase, 50K to 100K. 580 words. So you've crossed $50,000. You've avoided lifestyle inflation. You're deploying your compound advantage. Now what? This is where things get really exciting, because the path from $50,000 to $100,000 is dramatically different than the path from $25,000 to $50,000. From $25,000 to $50,000, you're usually grinding, working more hours, getting modest raises, maybe changing jobs. It's linear, predictable growth that takes years. From $50,000 to $100,000, if you play it right, this can happen in 2 to 5 years instead of 10. Why? Because you now have leverage. Leverage comes in 3 forms at this stage. First, skill leverage. You can afford to invest in high-value certifications, courses, and training. A $2,000 investment in the right skill can translate to a $10,000 salary increase within a year. Second, network leverage. You're attending conferences, joining professional groups, meeting people who can open doors. These connections create opportunities that simply weren't available before. Third, capital leverage. You have enough saved to take calculated risks. Maybe that's starting a side business. Maybe that's investing in dividend-paying stocks. Maybe that's real estate. And here's something fascinating. These three forms of leverage compound with each other. Better skills lead to better networks. Better networks lead to better opportunities. Better opportunities generate capital. Capital enables more skill development. It's an exponential curve, not a linear one. And this is why financial progress feels so slow at first and then suddenly accelerates. The key is recognizing when you're in the acceleration phase and leaning into it hard. This means being strategic about your next career move. It means saying yes to projects that build valuable skills even if they're challenging. It means investing in relationships with people ahead of you on the path. One tactical thing I see successful people do at this stage: they start tracking their net worth monthly instead of just their income. This shift from income focus to wealth focus changes how you make decisions. Because income is what you earn, wealth is what you keep. And in the $50,000 to $100,000 range, focusing on wealth building is what creates lasting financial security. Segment 7. The emotional reality, what nobody mentions. 520 words. Okay, we need to talk about something that doesn't fit neatly into spreadsheets or strategies, but it's absolutely real. The emotional complexity of crossing this threshold. When you hit $50,000 after years of struggle, you expect to feel relieved, grateful, maybe even happy, and sometimes you do. But often there's also guilt. Guilt about doing better than friends or family who are still struggling. Guilt about having what you need when you see others lacking. There's also imposter syndrome. Do I really deserve this? What if I lose it? Am I actually good enough to maintain this level? And sometimes there's resentment. Resentment that it took so long. Resentment that others had it easier. Resentment that you had to sacrifice so much to get here. These feelings are normal and valid. Financial progress isn't just a math problem. It's deeply emotional, tied to your sense of worth, security, and place in the world. What helps is recognizing that crossing $50,000 doesn't solve all your problems. It solves certain categories of problems, immediate financial survival stress, but it creates new challenges around managing complexity, navigating changing relationships, and figuring out your next level of purpose. And that's actually a good thing. It means you're growing. If you're feeling weird about your financial progress, that's not a sign something's wrong. It's a sign you're human and you're adjusting to a new reality. Give yourself permission to feel complicated about your success. Segment 8, the path forward, practical next steps, 480 words. Avatar, solution-focused, energetic. All right, let's bring this all together with practical, actionable steps based on where you are right now. If you're below $50,000 and working toward it, Avatar, encouraging. Focus on skill development that directly impacts your earning potential. Research what skills in your industry command higher salaries. Invest whatever small amounts you can in learning those skills. Network aggressively. Find people who are where you want to be and study their paths. Most people are willing to share their journey if you approach them genuinely. Optimize your current situation. Can you negotiate your current salary? Can you reduce one major expense to free up investment capacity? Can you add a strategic side income stream? And be patient but persistent. Getting from $35,000 to $50,000 might take 2 to 4 years of focused effort. That's not failure, that's normal progression. If you've recently crossed $50,000, resist lifestyle inflation. Give yourself a small quality of life upgrade, but bank the rest. This is your wealth building window. Set up automatic investing. Whatever amount you've decided to invest, make it automatic so you don't have to rely on willpower. Review your social circle. Are you surrounding yourself with people who support your growth? Are you creating space for new relationships while honoring old ones? Start thinking about your path from $50,000 to $75,000 or $100,000. What skills, credentials, or experience do you need? What's your 2-year plan? If you're well past $50,000, look back at when you crossed this threshold. What shifted for you? What do you wish you'd done differently? Use that insight to optimize your current level. And consider how you can help others make this crossing. Your experience is valuable. Share it. Conclusion. So here's what we've covered. The $50,000 threshold is real and it's powerful. It's the point where your brain shifts from survival to building mode, where compound effects unlock, where your identity transforms from scarcity to possibility, where your social environment can elevate you, and where strategic choices create exponential growth instead of linear progression. But understanding this threshold isn't about judging where you are right now. It's about seeing the game clearly so you can play it more effectively. If you're below $50,000, you're not failing. You're navigating a system that's mathematically harder at lower income levels. Every dollar you save, every skill you develop, every connection you make, it's all building toward that tipping point. And when you cross it, and you will if you stay strategic and persistent, you'll have the advantage of understanding what's happening. You'll avoid the lifestyle inflation trap. You'll deploy your compound advantage. You'll accelerate. If you're at or above $50,000, the question becomes, are you using this leverage intentionally, or are you just living in a more expensive version of your old life? Because the difference between someone who plateaus at $50,000 and someone who uses it as a launch pad isn't intelligence or luck, it's intentionality. It's about understanding that financial progress is psychological, social, and mathematical. It's about making the identity shift. It's about curating your environment. It's about resisting the cultural pressure to look successful and focusing instead on building actual security. You have more control over your financial trajectory than you probably realize. Not complete control. Systems matter, circumstances matter, luck matters. But within your sphere of influence, there are powerful choices you can make. And look, this journey is hard. I'm not going to pretend otherwise. Crossing $50,000 is hard. Maintaining discipline after you cross it is hard. Building wealth in a culture that constantly pushes consumption is hard. But hard doesn't mean impossible. Thousands of people make this transition every year. Many of them started with fewer advantages than you have right now. So here's my challenge to you. Take one specific action this week based on what you've learned today. Just one. Maybe it's researching a skill that could boost your income. Maybe it's having an honest conversation about money with your partner. Maybe it's setting up that automatic investment you've been putting off. Maybe it's just giving yourself permission to believe that financial progress is possible for you. Whatever it is, do it. Because understanding is only the first step. Action is what creates change. If this video gave you a new perspective on your financial journey, hit that subscribe button. I create content every week on building wealth intentionally and avoiding the traps that keep most people stuck. And drop a comment below. Where are you on this journey, and what's the one insight from today that hit hardest for you? I read every comment and I learn from your experiences too. The video I think you should watch next is right there. It digs into specific strategies for accelerating from wherever you are now to your next income level. Remember, the threshold is real, the opportunity is real, and you're capable of crossing it. I'll see you in the next one.